Okay, depreciation, they have three methods to calculate depreciation. So the first one is straight line method, second is reducing method, the third one is revaluation method. So it depends on your company policy. Some they are using straight line, some they are using reducing and the revaluation method. So what if your company is using straight line methods to calculate the depreciated value of the NCA? We use the cost price that the, the day one that you purchase the original cost price times the depreciation rate. It could be 10%, 20%, depends on the companies. So reducing method is depreciation equals to NPV times depreciation rate. NPV is the net book value, the current market value of your asset. So straight line method is using the cost price that you initially purchase. The reducing method is using the current market value, estimated market value to times the depreciation rate. Whereas the NPV equals to cost minus the accumulated depreciation up to last year, because this year you haven't calculated yet. So the accumulated depreciation equals to the provision for depreciation. When you see provision for depreciation in the trial balance of your question, then you know it is accumulated depreciation up to last year. So revaluation method. So usually this one is using for the small items such as the loose tool, even though you drop your screw or your nail and it's too small that you couldn't calculate one by one. Therefore, they use the lump sum of the opening balance that of this product, this NCA, plus if any additional NCA during the year minus the closing balance of the NCA. So the difference will become the depreciation of depreciation, which is only applied for the straight line method. Other methods cannot use this way to find the depreciation rate, and it cannot be found. So it must provided lah. So the first one, first step to find out this rate of depreciation is to find the annual depreciation amount. Annual means that every year how much I should deduct from my cost of the NCA in order to get the current market estimated current market value of this of such NCA. So the cost of the asset divided by number of expected years of use means that maybe I bought this computer I expected to use for 5 years. The computer price is 2000. 2000 divided by 5 equals to, that is the amount of the annual every year's how much I should drop from this cost price. Okay, or you can use cost of the sales minus the residual value divided by number of expected years of use. Residual value is the scrap value of the current the non-current asset. Means that no matter what, it will still worth for a few dollars or $20, $30, even though your computer is not functioning well. That is the remaining last value of the computers. So which is we call it residual value. If they provided, then you use the second method to find the annual depreciation amount. Okay, next one. Second, after you found your annual depreciation amount, then you can continue to find the depreciation rate, which is use the annual depreciation amount divided by cost times 100. That is the depreciation rate. But remember, this only apply for straight line method. Other methods you cannot use this to find the depreciation rate. Okay, recording depreciation in ledger. So all these things you have to prepare. Um, once you bought or purchase a non-current asset, you have to open a T account for non-current asset. Let's say your non-current asset is computer. So computer, then you draw a T and then debit your computer account and credit your bank or cash book. So this is the asset recording when you purchase a new NCA. What is the provision for depreciation of asset account? So this you need to open another T account and with the title of provision for depreciation of asset account. Its increase will be credit side, decrease will be debit side, because it will reduce your non-current asset, therefore it's opposite side. So whatever you increase, you record the current year provision for the depreciation of the year, then you must put it under credit plus. And when there is a disposal of the asset, so your disposal, you have to open another T account for disposal asset account. So this to find the whether you are making gain or making losses from the disposal. All this detail I will discuss in the class because I need a lot of the illustration in the T account. Thank you very much. Thank you so much. If any question, we will further discuss during the class.